day to you all. I'd like to welcome you to the financial reporting class. Uh, we want to continue covering our grounds. Today I want to look at reporting financial performance. Now I'm going to combine that with IS 8 that deals with changes in accounting policies, uh, estimates, as well as those changes resulting from errors. Okay, let's get on into it. Now, the standard IS 8 deals with policies, changes in accounting estimates, and errors. Accounting policies, of course, are benchmarks that accountants used in preparing financial statements. Now, where there is no accounting policy, where there is no authoritative statement from the International Financial Reporting Interpretations Committee, accountants are at liberty to use professional judgment. Right, so now let's progress. Now, when it comes to accounting policies, it's very important for us to appreciate consistency. Accounting policies must be applied consistently from one period to another, so that the changes in accounting policy are only allowed on two grounds. Please listen carefully, and I think that it's very important for you to be writing down what you're seeing. There are only two grounds for changing a policy. An accounting policy in this case will only change, number one, if there's a change in IFRS, and number two, if the change will be able to bring out reliable information. So what I'm hearing from that statement is that if we have got our own internal standards that are better than the International Financial Reporting Standards, and we feel that they are much more better, and the only way they can be better is if by complying with our internal standards, we at the same time fulfill the expectation of an IFRS, then we can always make a change. Changes in accounting policy must be applied retrospectively. That means the change will affect current year figures as well as comparative figures. And of course, comparative figures refers to figures for the previous accounting period in this case. Changes in accounting estimates. Changes in accounting estimates result from new information, developments, and are not corrections of errors. Now, changes in accounting estimates must be applied prospectively, meaning we are going to have to change current year figures, but of course that will have a cascading effect on future figures, so we have got the word prospective there. Right, let us progress to the next one. Whenever there's a change in accounting estimate, disclosure is necessary of the nature and amount, where of course effect is material. Examples of accounting estimates include, not necessarily limited to, irrecoverable debt allowance, useful life, or estimating the useful life of a depreciable asset, provision for inventory obsolescence, and so on and so forth. Prior period errors can result from mathematical mistakes. Now we're dealing with errors. Of course, an error is not necessarily fraud, because in fraud there's an intention, to gain financial or other advantages in a fraudulent way. But mistake, of course, may result from mathematical mistakes, mistakes in applying accounting policies, oversights. You see, where human beings will get tired, misinterpretation of facts, and fraud is included there. Prior period errors must be corrected retrospectively. If we found out that one of our employees was involved in, let's say, theft of cash or an asset in the previous year, we must recognize a charge, a loss in our profit or loss for the previous year, and of course that will reduce retained earnings for the current year. So all these mistakes must be corrected, or prior errors must be corrected through net profit or loss of the current period and less, material. So I want you to focus on that. Okay, so we also have IFRS 5 Assets held for sale. It is not unusual for companies to keep excess assets on their premises. IFRS 5, non-current assets held for sale, deals with that. But the IFRS also deals with discontinued operations. Of course, we can pull out of market already. We are living in an unprecedented period where, companies are shutting down. Non-current assets held for sale must be presented separately on the statement of financial position, preferably as a current asset. Of course, there must be some rules that go with that. Okay, now, discontinued operations include, a major line of business or a business that is in a different geographical area. These the results of discontinued operations must be presented separately again in the statement of profit or loss, all right? So that users can make meaningful comparisons of their financial statements. Okay, so now, if a non-current asset is going to be said to be held for sale, then there must be certain things that we should be able to see. Number one, the asset must be available for immediate sale. All right, so already that should have been decided. No turning back. The sale must be highly probable. I think that there must be a fair price attached to the asset, and of course, the asset should be in good condition. We should measure the asset at the lower of the carrying value and the fair value less cost to sell. And we should not depreciate the asset. Remember that we don't depreciate current assets. And then there'll be no offsetting of assets and liabilities held for sale. So I'd like for you to see that. So thank you very much. I'd like for you to get in touch if there be any question on what we've seen. I think it is prudent for us to turn to some questions just now. Okay, so I'm aware that that might not be as visible. So let's agree. So 175 now. Question 175 from your revision kits. Which of the following would be treated as an IAS 8 accounting policy change in accounting estimates and errors as a change of accounting policy? So our focus is change in accounting policy. So A says a change in valuation of inventory from weighted average to FIFO basis. I think that's a change in accounting policy. All right. Then B says a change in depreciation method from straight line to reducing balance. Okay, I think that one is falling under estimates. Then we have got adoption of the revaluation model for non-current assets. That falls under PPE. Capitalization of borrowing costs which have arisen for the first time. That falls under IAS 23. Okay, let's progress. Question number 2. So the best answer for 1, of course, is option A, where you are changing your valuation method from weighted average to FIFO. It means that you also have to apply the same method, previous year valuations. 176 says for an asset to be classified as held for sale under IFRS 5, non-current assets held for sale and discontinued operation in sale must be highly probable. Which of the following is not a requirement? The sale is to be regarded as highly probable. So number 1, management must be committed to a plan to sell the asset. Well, that is okay. A buyer must have been located for the asset. I don't think so. The asset must be marketed at reasonable price. I get that one. Then D says the sale should be expected to take place within a year. Well, that's still fair enough. So I think it is not necessary for us to locate a buyer. We just do the advertising and then somebody will pitch up. So B is not the answer. Is the answer in that case because it is not one of the requirements that we're looking for. I want us to progress to 177. Which says complete the statement using the options provided. An asset classified as held for sale should be measured at the lower of. I think that was made clear in our notes. If you go back, measure at the lower of carrying value, fair value less cost to sell, that does not, take too much time. So we will pick fair value less cost to sell, push it where it belongs, and also we shall get um, the carrying amount, right? The carrying value. Okay, so please let us remember that. So we are getting, please, I hope you can see carrying amount and fair value less costs. Fair value is one, less costs to dispose of. These are textbook lines. Right, so 178, what do we have there? Which of the following would be a change in accounting policy in accordance with IAS 8 accounting policy changes in accounting estimates and errors? So again, we are looking for a change in accounting policy. A says adjusting the financial statements of a subsidiary prior to the consolidation as its accounting policies differ from that of parent. Okay, so that is not correct. I think that one should be dealt with under, group. I think that's just an adjustment under group accounts. Then B says change in reporting depreciation charge as a cost of sales rather than as an administrative expense. That is the answer that we're looking for. When you do that, you discover that your cost of sales and your administration expenses will vary. There will be a change there. All right, and then C says depreciation charged on reducing balance method rather than straight line. I think that is an estimate. Then reducing the value of inventory from cost to net realizable value, that falls under IAS 2. Okay, so the best option is B. Please, let's make comparison with what I've sent you on the revision kit. 179, which of the following items is a change of accounting policy under IAS 8 accounting policies, change in accounting estimates and errors? Classifying commission earned as revenue in the statement of profit or loss, having previously classified it as operating income. Of course, this is going to change your gross profit as well as your total, income. I think this one we take. Switching B says switching to purchasing plant using leases from previous policy of purchasing plant for cash. Of course, that falls under IFRS 16. Nowadays, we want to suggest that it is taken under that standard. Changing the value of subsidiary inventory in line with group policy of inventory valuation when preparing the consolidated financial statements. Again, that falls under basic group. And then lastly, revising the remaining useful life of a depreciable asset. Okay, so that falls under estimates. I want to end there, and I would like to thank you so much. Of course, I would like to give you a challenge on question 8. Please revert, do that question and revert. Thank you very much.